And welcome to the fixed income material for the Level 1 curriculum. This is going to be something that will take a little while to get through. There's a couple of study sessions. There's lots of material to cover. In this initial study session, we're going to be able to talk first about the features of debt securities. I think this is something that is probably intended for those who really have had very little exposure to the debt markets. But nonetheless, there's some terminology here that you want to make sure you're on top of, because the terminology is always going to be important in the CFA curriculum, because of course that is the terminology that's going to be used to ask the questions on the exam. In addition to that, we'll spend some time talking about the risks associated with fixed income securities. We'll talk about the market sectors that are out there, and then in the end we will go and we'll discuss something on yield spreads, which is really how we talk about the value of a bond. Now, I think this is a particularly fruitful area of study for the exam. So in particular, if you're someone that has not been exposed to the debt markets very heavily, then I think this is going to be a great area for you to study in preparation for the exam. The reason being that what you see in your Schweizer notes is probably going to look a lot like what you see on the exam in terms of exam questions. And if this is something that you haven't studied much of before, you don't know a whole lot about it, then what you're going to find is that the learning curve is pretty nice, and you're going to be able to ramp up your knowledge and get some and actually encounter material that will lead to some points on exam day. So if you haven't had a lot of exposure here, it's probably going to take a little time to get through, but I think that overall you get a lot of bang for your study hour buck by studying fixed income, in particular fixed income at level 1. There's just a lot of underlying terminology and concepts and details, and then we're also going to get into the valuation, which is going to be relatively straightforward and something that is certainly going to be tested, and like I said, something that's going to lead to points on the exam that you can feel confident about when you see those questions. So here we're going to talk primarily, what we're going to do first is talk about the features of debt securities. And again, this is for someone, probably if you have a lot of exposure to the debt markets, this is going to be a review, so I would go through this once, make sure I know the terminology. But if you haven't been exposed to the debt markets, then there's probably going to be some things here that you'll have to spend a little bit of time making sure you understand. So first of all, talking about the bond indenture. Well, the bond indenture is the written agreement that governs the issuance of the bond. So this is where we specify all of the attributes or features that we're going to talk about in this reading. All of those will be specified in the bond indenture, and essentially it's a list of all the obligations that the issuer is taking on with respect to the fixed income security. On this slide, we're worried about two in particular. And both of them are covenants. The first is negative covenants. The second is affirmative covenants. Well, negative covenants, those are things that the issuer promises not to do. So it's going to do things like place restrictions on the sale of major assets, a negative pledge of collateral, meaning that you can't pledge this collateral for other senior debt, restrictions on additional borrowings. It's also going to prohibit large dividend payments and some things like that that would work to the detriment of the bondholders. The affirmative covenants are things that the firm must do. For instance, they must pay their taxes. They must report their operating results to the trustee. Okay? And as we see here, they have to maintain their some certain financial ratios, and then also have to, of course, make timely payment of the principal and interest. The financial ratios is an interesting one. It comes up elsewhere in the curriculum because financial ratios are going to depend in part on the operating environment for the firm, and the operating environment is not completely within the firm's management, or within the firm's control. So the notion here is that if there is some problem in the market, it could lead to some deterioration of, let's say, the interest coverage ratios, which would fall below what the firm has said they will maintain in their indenture, and then that is, in fact, technical default. So that's going to give the bondholders the option to demand payment, or in the more likely case, to renegotiate the terms of the bond. But nonetheless, the firm is going to take on a number of obligations in the form of affirmative covenants. What about bond features? Well, bond features, the two most important ones are the ones at the top here. Those are the ones we're going to use to determine the cash flows from the bond in the very simplest of cases. We'll get beyond the simple case eventually, but I think conceptualizing it in terms of a plain vanilla corporate bond is probably the best way to start. The first feature is the face value, also called the par or maturity value of the bond. Okay, so this is the nominal amount. It may not be what the firm actually brings. And if we're talking about bonds in North America or in the United States anyway, okay, then corporate bonds in the United States, 99% of them are issued with $1,000 par value or face value. The coupon rate is also called, so as long as we're giving things lots of names, the coupon rate, also called the stated rate or the nominal rate, is the annual percent of par that the firm is going to pay in interest. So if we wanted to look at this and think of a $1,000 par value bond with a 10% stated or coupon rate, okay, that would be a typical structure for a very plain vanilla corporate bond. What that means is that if we look at the cash flows for the bond, and we'll say that this has a maturity date of 3 years, so here's 1, 2, 3 years. Well, what are the cash flows going to look like to the bond? Well, we're going to take the coupon rate, we're going to multiply it by the par value, so that's going to give us a $100 interest payment each year during the life of the bond, okay? And then at the maturity of the bond, we're going to receive the final interest payment plus the return of the principal of $1,000. So in this case, we would get $100 at time 1, $100 at time 2, and $1,100 at time 3. Of course, the most fundamental, the most underlying premise of the CFA curriculum is that the value of any security or any asset is simply the discounted value of its future cash flows. What these first two features allow us to do, at least in the plain vanilla case, is to come up with the promised cash flows. Then we're going to go in and find some required rate of return, which I'll call R. We'll discount all that back, and that will give us the price here today at time 0. But that's really a story for later on. We'll see that in the next study session when we do valuation. Okay, other things that will be specified in terms of features. Hey, the currency denomination, of course, this is going to be in the example we use, US dollars, but of course it can be denominated in any currency. So you would frequently get large multinational corporations issuing bonds in multiple currency environments. You also get a number of, or many of the world governments that will issue debt in different currencies or currencies other than their own. So the Canadian government could issue US dollar bonds as an example. We could also have more than one currency specified, so you could receive interest payments in one currency and then you can get your return of principal in another. That's called a dual currency bond. All that would be specified in the bond features. Okay, the redemption. So redemption refers to how the firm will repay the loan. What we've described here in our plain vanilla case was one that would redeem at maturity. Okay, so and we'll see that there's some variation on that or some subtlety associated with it, but that's the plain vanilla case. These are interest-only loans and make interest payments for 20 years, and then you have the return of principal at the end of that. But we're also going to spend some time talking about debt instruments that are amortizing, meaning that they are making principal and interest payments through time, much like you might have if you were to finance a house or a car. Much consumer finance worldwide involves amortizing loans. So I have a loan on my house. When I make my payment, part of that's interest, part of that is principal. The principal is the amortization of the loan. We'll see this primarily in conjunction with asset-backed securities when we talk about securitization. So that will be an important topic, and it's going to become very important, in fact, at level 2. All right, so what about coupon structures? There's a number of ways that we could go in and structure the coupon payments for the bond other than the very simple case that I described in the last slide. So we could go in and we could issue zero coupon bonds, a popular instrument. This is also called a pure discount bond, and that simply means that the coupon is zero. So you don't get any payments during the life of the bond, and then you get $1,000 at the end of the bond. So these are sometimes also called deep discount bonds, although that would be a little more general heading. So a zero coupon bond or a pure discount bond, you buy the bond today at one price, it matures for $1,000 10 years from now. The difference in those prices is going to determine the return that you get for loaning your money to the firm. Okay, also, step-up notes would be another way to structure this. This is where you have a coupon that increases over time. This is a fairly common tool in the high yield or junk bond market. So you'll have coupons that are 1% the first year, and then 3% the second year, and 5% the third, and then they level out at 7% after that. That would be an example of step-up notes. The coupon is increasing in a structured manner that is okay, this is where the bond has a coupon rate, but they are not actually going to disperse those coupon payments to the bond holders. Instead, those are going to compound through time. There's a number of ways you can handle that, but one of them would be to simply increase the maturity value of the bond. Again, all this is very clearly specified at the outset. It's not like the firm has an option here of changing between those, except in the relatively rare case where the indenture gave them the option to jump back and forth, but I've never actually seen any bonds like that. All right, so what about floating rate securities? So what we've talked about so far has been more in line with the idea of a fixed rate coupon. So that is, it may change through time, but we know what it's going to be in each period, and that the amount of that payment is specified at time zero, that is at the issuance of the bond. So even if it's a 30-year bond with semi-annual payments, so you've got 60 payments stretched out in front of you, you know what each of those promised payments are. Now, you may not know the expected payment because you'd have to think about bankruptcy problems, those types of things, but at least you know the promised payment. Okay, and a counterexample to that would be a floating rate security, okay, much like a floating rate loan on a house. So in the United States, we use floating rate mortgages on occasion, and what that says is we're going to make payments based on some sort of reference rate. Okay, maybe that is the 10-year Treasury security, maybe it is something that's promulgated by Ginnie Mae, but if interest rates go up, then the interest rate on your loan goes up. If interest rates go down, then the interest rate on your loan goes down also. So typically you're going to have a coupon formula. That's going to be a reference rate, which is determined in the indenture, but that will reference a particular measure of market interest rates, like the 10-year Treasury or the 30-year Treasury bond, or something else out there, New York Prime, something along those lines, and then a fixed margin. So that is a spread above the reference rate. So a good example would be LIBOR, which has become a very common metric for floating rate securities, okay, plus a spread of 1.5%, okay, and these are going to be annualized. So if LIBOR was 1%, then the rate this period would be 2.5%, the 1% LIBOR plus the 1.5 spread. If LIBOR were to go up to 5%, then the rate on the bond that year would be 6.5, the 5% LIBOR plus the 1.5% spread. So the reference rate, it determines the reference rate that will be used throughout the life of the bond. That will change. Typically, and for our purposes in the CFA curriculum, the margin will be fixed over the life of the bond. Okay, with these floating rate bonds, there's also always the possibility that interest rates are going to go to 25% or 40%, or they're going to go down to 0%. Well, what we can do is we can create at origination a cap or a floor on these particular securities. So a cap will give a maximum to the formula rate. So it'll say, look, we're going to pay the reference rate plus 1.5%, but never will the rate go above 7. So if interest rates go up to 5% plus 1.5, that gives us 6.5% would be the coupon formula. But if interest rates go up to 6%, then we'd have 6 plus 1.5, that would be 7.5. But if we had a cap at 7, that would be the maximum that the firm would have to pay in any given period. So a cap, who is that protecting? Well, a cap is obviously protecting the issuer. Okay, we can also put a floor on this, so we can say we could give us a reference rate. Maybe it's LIBOR plus 1.5, but never less than 2.5%. So if LIBOR went down to 1.5%, then we'd have 1.5% LIBOR plus the 1.5% spread, which would be 3%. But if LIBOR went down to 0.5%, okay, and so we had 0.5% plus 1.5 is 2, but we had a minimum of 2.5%. Well, the minimum is protecting the bond holder. So caps and floors, just the maximum and the minimum that the firm will pay in any given period. So what about this idea of accrued interest? So this is something that I would pay attention to. It's easy to write questions about, so therefore I think it's easiest to show up easy to show up on the exam. So this is going to be, the notion here is that When we value bonds, we're going to calculate values, and it's going to be easy. We're going to take our calculator, we're going to plug in some buttons, we're going to punch some buttons, and we're going to get a value for the bond. Okay, well, the thing you need to remember is that is the clean price, that i.e., that assumes that we are buying or selling the bond on a coupon date. Well, if you look at a bond that issues annual coupons, so they're making a payment once a year, what if we buy the bond in the middle? Okay, well, if we buy the bond in the middle of the year, then the person that we're buying it from, or the party that we're buying it from, has held the bond payment, but of course they're going to sell the bond when the firm actually makes the payment. They're going to make all of that interest payment to whoever's holding the bond at the end of the year. So the way we do this is we calculate the accrued interest. That is, how much of the next coupon payment has the seller of the bond earned, and then the buyer is going to pay that to the seller. So if we think of this as having a bond with a $100 coupon, as in our previous example, so let's say that they're paying $100 a year, and it's been 180 days since the last coupon payment, and there's 360 days in a year to keep things simple. So of course 180 over 360 is 0.5 times 100. Okay, that would give us accrued interest of $50. What that means is that if you were to buy the bond today, we could calculate the clean price from our calculator, but then the price that we would actually be invoiced for, called the full price or the dirty price, the full price would be the clean price plus the $50 in accrued interest. So what happens is we hold the bond for half a year, but we get the whole $100 coupon payment. So we pay to the seller of the bond the portion of the coupon payment that they have earned, and then we keep all of it when it comes in. There's no adjustment for time value of money. It's simply the accrued interest. So this is the market convention, so you ought to be ready to deal with that. It's not a huge deal, but it's something that is a good nod to practice, and I think, like I said, it's easy to write test questions over this, so I think it's something that can show up on the exam. Always look for things that are easy to write test questions on. All right, so what about amortizing versus non-amortizing bonds? Okay, well, the typical case, so what we're going to spend most of our time dealing with at level 1 is a non-amortizing bond. That means when you receive a payment during the life of the bond, it is very likely to be just interest payments. So there's not going to be any principal payments that are, at least not that are embedded in the normal loan proceedings associated with these non-amortizing loans. So, coupon treasury bonds, those are of course non-amortizing. Almost all corporate bonds are non-amortizing, that is, if they're issued against a particular operating firm. So anyway, these are bonds that make interest payments during the life of the bond and then a return of principal at the end of the life of the bond. Now, there is another term here that we need to talk about in a little, we'll see a little more of later, and that is the idea of a sinking fund. So a sinking fund is going to be some return of principal during the life of the bond, but it's going to be under special circumstances. So I think you can still have some return of principal during the life of the bond in terms of a sinking fund, and it still be a non-amortizing bond. So don't let those two concepts confuse you. We're going to come back and talk about sinking funds in a little while. Okay, the alternative to a non-amortizing bond is, of course, an amortizing bond, and that's a security is going to make equal payments over the life of the bond. Each payment is going to be some interest and some principal, and at the end of the life of the bond, you will have received all of your principal. There's not this big balloon payment at maturity. While there's a lot of smart people out there that do nothing but sit around and think of ways to tweak what's going on in the bond market to make the cash flows a little more specialized and therefore a little more valuable to one party or another, the best case, and the case that we're going to deal with almost exclusively within the CFA curriculum for amortizing bonds, are going to be asset-backed securities. So we're going to take some mortgage obligations, and we're going to securitize those, or maybe some credit card receivables, and we're going to securitize those, since the underlying loans, the loans that are being used to securitize those obligations, which if you're not familiar with asset-backed securities, don't worry, we're going to get there, but the underlying loans make principal and interest payments, then the securities that we form from those loans will be amortizing loans. That is, they'll make both principal and interest payments every period. So amortizing versus non-amortizing, that's going to end up being a big concept, going to come into play more at level 2 than it does at level 1. Now, what about a call provision? So a call provision, this is a really important deal. And if I had to specify to you what's going to be the difference between what you see at level 1 and what you see at level 2, at least in regard to valuation. At level 2, we're going to deal with call provisions. This is also called an embedded option. Okay, that means that the firm has the right to call the bond back prior to maturity. So the issuer can repay principal prior to maturity if they choose to. So you think of it this way. Well, we've loaned money to a corporation for 20 years, so we said, here's a 20-year loan, you're going to pay us 7% each year, and we have this 20-year agreement. But if the bond is callable, then the firm, under some set of circumstances, which we'll elaborate on a little more, but under some set of circumstances, has the right to repay for some period of time, but that won't, if the bond is callable, of course, that can't extend over the entire life of the bond. There's also non-callable bonds, but a callable bond is one where the firm has the right to prepay. And of course, when do they want to do that? Well, firms want to prepay if interest rates fall, right? So if you say, well, I have this loan that I've got at 7%, interest rates go down to 4%, then what I would like to do is issue some 4% money and call back that 7% money. So to pay off the loan early. So typically the call provision is a good thing for the firm, but a bad thing for the bondholder. So all else equal, bondholders aren't going to like this. And of course, if you don't like it, that means the bondholder is going to require a higher yield. Now, if we think of the way this call works, it's very typically structured or staged in. So if it's a 15-year bond, then maybe it will be callable after 5 years at 102, meaning 102% of par. And then after 10 years, it's callable at par. So they can't call it at all for the first 5 years. If they want to, between years 5 and 10, if they're willing to pay 102% of par, or that would be $1,020, then they can call the bond back early. And after 10 years, they can just call it at its par value. And what we're going to see is this is a problem for the bondholders, because as interest rates go down, the value of these fixed income securities goes up. So when you say, well, the interest rates have gone down, the value of my bond should be going up, well, this call provision, that's when the call is going to be exercised, and of course that's going to be bad for the bondholder. Now, what I just described in the last slide was not just a call. That was actually could be referred to as refunding. So when we said, all right, we issued some bonds at 7%, interest rates subsequently go down to 4%. Well, what we're going to do is we're going to call our old bond, but we're going to do it with the proceeds from a lower cost issue. Okay, so we're going to call our old bonds, but we're going to have to issue new bonds to do it. Well, that's not just a call, that's refunding. So what we can have is a bond that's callable. That is, if the firm can call the bond, they can retire the bond early if they have enough money to do so out of operating profits, but they can't go out and issue new bonds in order to be able to do that. So a bond can be callable, but not refundable. So the refunding thing is the typical scenario for when we're going to call it. The bond is both callable and refundable. Interest rates have gone down. We're going to issue some new bonds. We're going to call back the old high interest rate bonds is the way that would work. A prepayment option. A prepayment option for our purposes is the same thing as a call, only this is for an amortizing security, such as a mortgage. So you have this prepayment option, and that means that anytime you want, you can call the debt back. So I'm a mortgagor, okay, I've issued a mortgage to the bank in order to buy my house. They're the mortgagee, and I have a prepayment option. So most mortgages in the United States have a zero penalty prepayment option. So if I want to, I could put an extra $100 in my principal, $100 in my mortgage payment each month, and I could return some principal at a faster rate. I could also, if I chose to, pay off the entire loan. So sell my house, pay off the loan, or if my rich Aunt Tilly dies, I could have some money, I could prepay that. Well, the prepayment option is analogous to the call option, but we use the prepayment option term when we're talking about amortizing securities. So prepayments are repayments of principal in excess of the scheduled principal payment. That can be all of the principal or just some of the principal, but that would be the prepayment option. Now, we've talked about sinking funds a little bit previously, but here's perhaps a more complete discussion. So the notion is this. So think of a bond that a firm that issues, let's call it a $10 million bond issue, which would be really small. But anyway, so a $10 million issue, it has a 10% interest rate. And so I guess this is a relatively small firm. Anyway, they're making $1 million payments, and it has a 10-year maturity. So if it is a non-amortizing bond, The plain vanilla version of that would be to make $1 million interest payment every year for 10 years. Well, that's fine, but in the last year, the firm suddenly has to make $11 million in payments, right? The final interest payment plus the return of the $10 million par value. Well, that leads to a problem called crisis at maturity, which means the firm can deal with the interest payments fine, but because of the conditions of the credit market or the credit standing of the firm, they're having a hard time issuing new bonds or obtaining new debt, and they don't have enough money to redeem the bonds out of operating profits. Well, that's going to lead to some sort of crisis at maturity. Well, a sinking fund, okay, is something that's going to help deal with that. So sinking fund redemptions are called to occur at par. So what might happen is instead of waiting till the end to get the $10 million back, maybe starting in year 5, the firm will have to set up a sinking fund of $500,000 each year so that by the time they get to maturity, some portion of that, a couple of $1,000,000, is already in a fund there to service the debt at maturity. So a sinking fund criteria. Now, there's two types of bonds out there from the bond buyer's point of view. There are premium bonds and discount bonds. A premium bond is one that sells above its par value. Well, what happens if the firm has the obligation to retire some of the debt? Well, if they have the obligation to retire some of the debt and the bonds are trading at above par, well, the sinking fund provision typically gives them the right to buy the bonds back, that is to redeem them at par value, but whose bonds are they going to buy? Well, the bonds are actually selling for, $1,100 in the market, but par value is $1,000, so how are they going to retire those bonds at par? Well, what's going to happen is we're going to have a lottery. So they're going to give the cash to the trustee is going to hold a lottery, and if your number comes up, then you're going to have to take your $1,100 bond and you're going to have to give it back to the trustee for $1,000. This is probably the only type of lottery that I will ever win in my lifetime. Anyway, so when you talk about winning the lottery, it doesn't necessarily mean it's a good thing if you are a bond investor. However, what if we have discount bonds? So what if the bond it has a par value of $1,000, but it's trading for $900? Okay, well then it's selling at a discount. In that case, rather than give the cash to the trustee and have them buy back some bonds, okay, the bond issuer can simply purchase the bonds in the open market and then deliver the required number of bonds to the trustee. So for the bond issuer's point of view, if the bond's selling at a premium, they can buy them at par, which is a good thing. And if the bond is selling at a discount, then they'll just go into the market and buy the bonds back at whatever the market price is. Now, what about redemption prices? When we talk about a call price, so the firm is calling an issue, that's called a regular redemption price. Okay. On the other hand, sinking fund redemptions and redemptions that come from other sources of required redemption, something like a forced asset sale, those occur at special redemption prices. So when we talk about the sinking fund, we can have a bond that's callable at 102, but if we have a sinking fund requirement, so the firm has to redeem part of that bond, well, they're not going to do it at the call price. They're going to do it at the special redemption price, again, that is specified in the bond indenture agreement. Okay, embedded options, this is something that you need to pay a lot of attention to. It's going to be one of the prime things that you're going to see at level 2. But the notion here is that what we have is we have a security like a plain vanilla bond that has embedded in it. That is, we can't separate these two things out. It has embedded in it an option, the right but not the obligation to do something. So there are options that benefit the issuer or the borrower. Okay, if that's the case, then they're going to decrease the bond value, which is the same thing as increasing the yield. So the best example of this would be something like a call provision. So the call provision gives the issuer of the bond the right to lower their financing cost if market interest rates fall, right? So that's not a good thing for me. I don't want my money back just after interest rates fall. So what I'm going to do, if I'm going to buy a callable bond, I'm going to demand a higher yield up front. So something bad, that's the call, then I have to get something good to balance it out, that's a higher yield. There are also embedded options that benefit the holder or the lender, okay? And if it's something good for me, so all else equal, I'm receiving an option somehow in the structure of the cash flows. Well, if I receive an option like a put option, that is the right to put the bond back to the firm, so that protects me. If interest rates go way up, I can put the bond back to the firm, get my money back and invest at the higher rates. But if it's an option that benefits the bond holder or the lender, then it's going to lower the yield. So if you get something good, you have to give up something good in the process. So here is a little table. I would actually make sure that I understood what was going on here. So it gives us the type of option on the top, okay, and it gives us who it benefits. Okay, I would have actually extended this table, so I'm just going to extend it here as we discuss. So I would have extended this table so that I could have discussed or made sure I understood what's going to happen to the yield to maturity on this bond. All right, so the yield to maturity, or YTM. It's not a huge leap to go from the second column to this third column that I'm putting on here, but the questions on the exam are probably going to center on what is going to be the impact on yield. So looking at these, what we see is that benefits the issuer. Well, if it benefits the issuer, then I, as the bond holder, am going to require a higher yield. Okay, so we're going to see that the yield to maturity on those will be higher. Okay, if it is a prepayment option, well, remember we said that's like a call provision for an amortizing bond, so that's also benefiting the issuer. So that's also going to drive up the yield to maturity. The put provision, however, is issued for the benefit from that accrues to the buyer. So if I'm the buyer, I have the right to put the bond back to the firm. Let's call it at par value. So I can always give the bond back to the firm and get my $1,000 back. So if interest rates go up, then I can put the bond back to the issuer, get my $1,000, and buy bonds that have a higher yield. Well, that's good for me. So in order to get that, I'm going to have to give up some return. So we'll have a lower yield there. Conversion option, so this is the right but not the obligation on the part of the bond holder to take their bond, give it back to the company in exchange for equity securities, that is equity in the firm. So if in the chance that the equity value of the firm goes through the roof, they develop a cure for baldness or whatever it happens to be, hey, well then I would really like to own the stock of the company. Well, this gives me a way to earn the stock or to get the stock. I give them back my bond. I get this really valuable stock. So again, that benefits the bond holder. So all else equal, we'll see those bonds have lower yields. Caps, we already said very early in this reading that a cap protects the issuer of a floating rate bond. So all else equal, if you want it capped, I'm going to require a higher yield up front, and the floor, of course, benefits the buyer because it keeps the interest rate or the coupon rate based on the formula from going too low. So if you give me some protection against low interest rates, I'll be willing to accept a lower return. So the yield to maturity there on the end, I would make sure and have a good handle on what's going on with the embedded options and who it's going to benefit and what the impact is going to be on the yield for the bond. All right, and finally, with this little reading that's been mostly introductory material, okay, what about margin buying and repurchase agreements? Well, margin buying, here we're borrowing funds to purchase securities. So we talked about that in the equity material. Same thing here. So we're going to buy a bond. It costs $1,000. We're going to get a loan for part of that, and then we're going to use the securities that we buy as collateral for the loan, just like we were buying stocks on margin. No difference there. Okay, what is different here is the idea of a repo agreement or a repurchase agreement. Okay, this is where an institution sells a security with a commitment to buy it back in the future at a higher price. So we go in and we can say, well, we're going to sell the bond today for $9.99 and we'll buy it back tomorrow for $1,000. So we sell the bond today. That means we're going to bring in some cash, right? And then we agree to buy it back tomorrow. That is a source of short-term financing. Okay, most bond dealer financing is achieved through the repo market. So this is a very common sort of thing. What we'll see is that there's we can calculate the rate. Okay, so this is nothing but the holding period return. So remember when you look at the formulas you see on the exam, you ought to try to understand what's going on there. You can't memorize your way into passing the CFA exams. So if we look at the holding period return, okay, there's two specifications of that. So one of them would be the price at time 1 minus the price at time 0 plus any cash flows that we received, okay, divided by the price at time 0, okay, P0 today. All right, the other one, and what we would use in the repo market more frequently, if there's no interim cash flows, we can do the same thing. It's algebraically equivalent, P1 over P0 minus 1. That's supposed to be a 1 there. So that's the holding period return. Okay, well, this is how we would calculate the repo rate. So the price tomorrow that we're going to buy it back at, that's price 1. The price we sell it at today, that's P0. Subtract off the 1, and then we would go through and annualize that somehow. But that would give us a definition of the repo rate. So remember, when you're looking at formulas on the exam, you need to be able to see these individual components. That will really help your understanding. So we can calculate the repo rate as a holding period return, and then we can annualize. Okay. Also, there's a couple of types of repos. Overnight repos. Obviously, those that occur overnight. We sell it today, we buy it back tomorrow. We're providing short-term financing. And then term repos, that is a repo that exists for more than just an overnight period. So maybe it's 2 or 5 or 20 or 30 days. That would be a term repo. That market is also something that bond dealers could access. Okay, the overnight repo market, though, is very well watched and very. A discussion of bond features. Okay, again, very simple. But if there's anything in here you don't understand, you need to make sure that you get on top of these very basic principles before you go on and look at any of the other items or the other study areas in the fixed income material.